Welcome to Between Showings, the podcast where two sisters in real estate sit down with people behind the homes, businesses, and stories just shaping our community, from real estate and entrepreneurship to design, motherhood, lifestyle, and everything in between. These are the conversations happening between showings, and I am so excited to welcome a mortgage lender in the industry, Taylor Dalkey, today.
Hi, I'm so happy to be here. Thanks, Danica.
Yeah, tell us a little bit more about yourself. How did you get into lending?
That is a great question. I've been lending for coming up on a decade. I was actually, so I graduated college. I'd moved down to the greater Milwaukee area. I'm originally from like central-ish Wisconsin, and I was working at a bank, and I was still bartending and waitressing nights and weekends, which is what I had done to put myself through school. And
Yeah.
I'd actually met my former manager while I was serving, and she knew what I did like at my day job, and she'd asked me to just like meet with her and grab a drink, and I signed a contract with her like 2 weeks later.
That's awesome.
I went all in. Yes.
That's awesome. What do you love most about helping people get into their homes that they dream of?
Yeah. Okay. So like I'm a big rooter for the underdog,
Yeah.
and I just like I love all of my clients truly. But the ones that I feel that make the most lasting impact are the ones that like other people didn't give a fair shot. The
Yeah.
ones who maybe don't have a perfect history or perfect background. Because the reality is like at some point, life will happen to every single one of us.
Hmm.
And like when these clients come to me who have just overcome maybe like a couple years of really just bad luck, and we're able to get them into a house and like
Hmm.
change their life and their family's life, like those are the most impactful.
I love that. What do you feel like, being in the industry for a while now, what do you feel like there's something that people just misunderstand about what a lender actually does?
So many things. So here's like my day, my every single day looks so different for me. And like as lenders, we wear
Hmm.
so many different hats, and we all run our businesses very differently.
Yeah.
I don't know if I know a single lender who runs their business the same exact way as me. And that doesn't mean like good or bad. It's just how I like to do things, and
Hmm.
like what my touch points are to just make sure that the client is having having a transaction run smoothly, and also just the experience that they have overall.
Yeah, totally. That makes
So
sense.
some days I'm like on my computer all day, just running numbers, doing pre-approvals, like, collecting conditions, having like client calls, introduction calls, follow-up calls. And sometimes I'm out at coffees, lunches, real estate offices. Sometimes I'm on a podcast, and
Yeah.
sometimes I'm sitting on Canva doing my marketing. It's
Right.
literally, it's so many hats.
I believe it. It's very similar to real estate and agents. And, when we talk to buyers, before people even start really looking, I always obviously advise talking with a lender first. And especially in today's market, you need pre approvals if you're going to submit an offer. And likely you have to submit an offer pretty quickly. So having that all set up, ready to go, is obviously very important for my side of things. But from your
Yes.
side of things, why is it important to get a pre approval?
Such a good question. I just actually was talking with a client earlier this morning about this. Here's why. Number one, if the perfect time to start getting pre approved and talking with a lender, I think, is like 6 months before you actually want to start shopping for a house. Here's why. It's
Hmm.
not every pre approval is cookie cutter and vanilla. In fact, like very few are. And if we
Hmm.
can take the right steps and start having the right conversations and talking about like not just what your goal is in 6 months, but like what's your goal in 3 years, 5 years, and what's a monthly payment you actually feel comfortable with, not just what your max pre approval is. And it's fine when we do rush pre approvals. However, like as a client, if you have time to sleep on these numbers and like really just have a moment to breathe and think like, is this the best decision for me? Like you're just preparing yourself and putting yourself in a much better position. The other thing is like, as we're pre approving a client, you would not believe how many times, like, for instance, when I run credit, how often I'll find something like so silly on a credit report, which could be like a copay for a medical collection. And
Yeah.
oftentimes the client doesn't even know it's on there, and it can be affecting their credit score by 75 points. That's a really big deal when we're
Wow.
kind of deciding like what's the most advantageous loan program, the interest rate, the PMI rate. And so if
Mhm.
we can figure that out in advance and then work on getting that removed, you're just putting yourself in a better position when you do go out shopping.
Is there an ideal credit score someone should aim for?
Great question. So, yes and no. The higher, the better. The higher your credit score, the lower your interest rate's going to be, the lower your PMI is going to be. In 2026, I'll be honest, 760 is the new 740. So 740 used to be like, if that's your credit score, like you're in the top tier. And we've seen that shift to
Mhm.
760. So 760 and above is like phenomenal, great job. 700 to 760 is still good, but we do loans all the way down to 580 and even lower if we have compensating factors.
Got
So like when we're sitting at that 700 mark, I feel like that's
Yeah.
kind of like seven, and that's tr- I say this all the time. Like back when I had started lending, like 700 was like the dream credit score. And
Mhm.
things have just shifted so drastically since COVID.
Yeah.
But when we get to like that 700 range, that's when we start looking at comparing an FHA offer with a conventional. Like
Mhm.
apples to apples, what did the numbers really look like? Because you might find that, for instance, an FHA loan with that credit score could be hundreds of dollars cheaper per month on your monthly payment. Yes. But then we also need to strategize. Like,
Mm.
do you still
Yes.
have a competitive offer?
Right. There are so many loan programs out there since we're talking about that. And without getting too technical or in the weeds, what are some of these programs? Like, who are they actually designed for? I know there's obviously conventional loans, FHA, VA, USDA, first time homebuyer programs. There's also down payment assistant programs. What are you
Yes.
seeing and who are these programs really designed for?
Love. Okay. So you listed off like your main QM loans, which stands
Uh-huh.
for qualified mortgage. So they're insured by Fannie, Freddie, Ginnie. And each one, like conventional, is going to be your, I'll say 700 and above
Uh-huh.
credit scores typically. And these first time homebuyer programs, they can be with conventional loans, they can be with FHA. There's different agencies like WIDA is
Uh-huh.
Wisconsin's housing agency who offers down payment assistance for both conventional and FHA loans. Um, and so like all of these are phenomenal, but where I've really leaned into in the last couple years are what we call our non-QM loans. And those are loans like your bank statement loans, your 1099 loans, your DSCRs, your asset depletions. And those types of programs, those non QMs,
Uh-huh.
are game changers. So, for example, like a bank statement loan would be advantageous for a self employed borrower who shows a lot of money like on their monthly bank statements and their deposits, but maybe their tax returns don't look as healthy.
Uh-huh.
And so if we're if we were qualifying them on a conventional loan, like we're calculating the income based on their tax returns from the last 2 years.
Sure.
When we do a bank statement loan, we are using the average number of the monthly deposits, whatever that amount is, averaged over 12 months. Yes. And so like I'll just give you one example. I have clients who the difference between conventional loan and going bank statement loan
Uh-huh.
for monthly qualifying income, it went from $6,000 a month to $153,000 a month.
Yeah, that's crazy.
Yes. So, and we do dozens of those a year.
Uh-huh.
Same with our 1099s. asset depletion, which is an incredible tool. It's any money that you have tucked away. It could be checking, savings, it could be like retirement funds, stocks. And we have a calculation that we use that amortizes those balances over 5 years.
Uh-huh.
And that's the amount we can use for qualifying. Whereas, like a typical Fannie Mae conventional FHA would require us to amortize that amount by 30 years, and you have to be a certain age.
Yeah,
So it just opens the door to so many opportunities, but those have like quickly become like my favorite category of lending.
I love that. And when we talk a lot about first time home buyers too, especially ones that are super green, are used to the 20% down. When you look at some of those programs, they could do almost as little as none down. Talk
Yes,
a little bit about that for first time home buyer
absolutely.
opportunities.
Yeah. So I built my business on these programs. I was young when I got into lending. And so that was my entire sphere
Hmm.
were young first time homebuyers and nobody really had money saved yet.
Yeah.
So I learned those programs like they were the Bible. So a lot of times when we're using the down payment assistance programs, we can get the loan structured so that their full down payment is being financed into a second loan that's repaid over 10 years. Some of these programs also allow you to finance in some of the closing costs. And then, in addition, like as we're strategizing and putting together an offer, sometimes you'll go in and ask for some seller credits. It really depends on the property and the market and if you're still writing a competitive offer. But oftentimes, first time homebuyers can get into their first home with $1,000 to $4,000.
Wow. Yeah, that's
Yes. Yes.
really, really interesting. When we talk about first time home buyers too, especially in market right now, people are scared of interest rates. In your opinion, do you feel like they should really be obsessing over interest rates? What are your thoughts around that?
Yeah, no, I don't, right? And I know that's like cliche to say because the interest rate is important. Like, I'm not naive to that.
Yeah.
But instead of just focusing on that interest rate, let's focus on a monthly payment that feels affordable to you
Hmm.
and manageable. And taking it a step further, like if you were a client who had tucked away some money in savings to buy a house, and then I'm looking at everything with you, sometimes it will make more sense to apply some of that money to pay off a different debt.
Hmm.
For instance, like you could have $10,000 left on a car loan and your payment's $500 a month. That same $10,000 could either pay off that car loan and get rid of $500 a month,
Hmm.
or you could apply it to the down payment on your house and your payment will go down $50 a month. And so I know that I'm stretching from interest rate, but
Hmm.
it's not just rate. It's
Right.
taking a look at the overall picture and finding a way to make things work in your budget. And I know we're all sick of hearing it, but like your interest rate is not forever.
Right.
Like if there's an opportunity where rates come down and you're in a better position, like you're going to refinance into that lower rate.
Hmm. Yeah. I mean, I think rule of thumb is like if it's a percentage different, it's worth refinancing. Is that correct?
100%. And sometimes it even makes sense, like if you're at a 0.5%,
Hmm.
depending on when you bought, how much equity you have. Sometimes you've lived in the house for 2 or 3 years and it's only a 0.5% lower,
Yeah.
but it's getting rid of your PMI as well. And so in that case, like I just ran numbers very similar to that and it was saving the client like $250 a month.
Yeah. Which be
That's a
worth it.
lot.
Yeah.
That's so worth it. I personally always run break even numbers for a client. And I have my own rule of thumb. Like, I think that if you're not going to break even in 36 months, it
Mhm.
doesn't make sense.
Right.
But that's just my own opinion.
But it is interesting though. I think going back to even when we were talking about buying at the top of your approved limit, but I feel like sometimes the thing that's forgotten is just general lifestyle. And I always say, do you want to be house poor or do you want to live in a house that you love that fills your needs but also allows you to live life outside of that home.
That. And because here's the thing, like, we are living in a time where comparison is the thief of joy. Like, we see it everywhere. We see it all over Instagram. We see it on every news feed. And what I've learned is that, like, no matter what we have, it feels as though like we're always looking for the next best thing.
Yeah.
And you don't have to have your dream house when you're 25 or 30 or 35.
Yeah.
Like, it's okay to be okay with what you need
Mhm.
and be able to have flexibility to still go out on date nights, still
Yes.
be able to go on vacation,
Mhm.
still host parties at your house.
Yeah.
So I say that often because, like, you could live in a $2 million house, and for some reason, like, you're still going to be looking at the $2.5 million house.
Mm,
Just comparison is the thief of joy.
totally. I couldn't agree more.
Yes.
When it comes to that first time home buyer understanding the mortgage process, I always say I will set them up with someone like you to get their pre approval. I'll set them up on a home search. We'll start looking at things and then house shopping and then hopefully accept an offer. And then from there, what is that mortgage process like?
Yes.
The loan
Okay.
application.
Yes. So at that point, typically, like, I've already been in communication with the client because we've done a pre approval, we've had an initial consult, we've run through all the numbers, we've run through several scenarios. And so at that point, once they're under contract, like, we're normally pretty familiar and comfortable with each other. I then go through that contract. I um, look to see, like, what documents might we need updated.
Mhm.
And then I will reach out to the client, congratulating them, and then also setting the expectation. So, like, congrats. These are the really important dates that we want to keep in mind and put on our calendars. And this is what I need from you by this date. And then at that point, I'm also sending the client initial loan disclosures
Mhm.
to review and e-sign. And that is where your initial loan estimate is comes into play, where you're reviewing, okay, what is the amount of financing? What is the interest rate? How much are the taxes and insurance for escrow if I hadn't already ran those numbers for the client? But that we're going through that loan estimate together to make sure that that client knows exactly what all of these numbers mean. Mm. And that any questions they have are being answered because they've never had to do this before. So
Right.
they don't know what they don't know. And
Mhm.
it's our job to lock arms and guide them and make sure that they feel supported. Like, this is one of the biggest purchases you ever make. So it's
Right.
kind
Do you feel like there's a commonality or a common space where buyers get tripped up on the process? Is there like one thing that stands out where it's unexpected?
of, so I feel like it could be slightly different for different people.
Yeah.
But yes, so one thing, this is one thing I feel like I hear more often than I would expect is that, like, buyers don't realize that they have to be at closing on closing day. And so, like, I've made it a part of my process to say, like, hey, by the way, closing date is August 20th. Like, make sure
Mhm.
you're taking PTO if you need to.
Yeah.
And another part is just like paying for the appraisal.
Yeah.
So we as lenders most often will send the client a link to pay their appraisal in advance. Once that appraisal is paid, the appraisal gets scheduled and cost gets deducted from their total cash to close. And that can sometimes, we like have to talk through that and just kind of explain, like, this is why we do that, which is because if anything were to fall apart and they don't end up purchasing the home, that I end up eating that cost.
Right.
And it's not fair either. But the other important thing that first time homebuyers don't generally know is what are tax, like, what is escrow? Like,
Mhm.
what is an escrow and what is a prepaid item? And simply, it's the funds that we're collecting at closing to put into an escrow account for your taxes and your homeowner's insurance
Mhm.
so that there is enough money in that account when it comes time to pay those things. And we do that. Like, for instance, if you're a client and you're buying a house and closing in, oh, you're not making a payment until October. So you technically get to live in the house for 2 months.
Mhm.
And we just have to make sure that enough funds are allocated to still pay your taxes and your homeowner's insurance when they come due.
Right. Right. Since, yeah, people do get tripped up, and it is weird looking when you're like, oh, well, it's only X amount and you have to put in more money than you expect. It can be
Yes.
interesting.
Yes, it is. And which is why I think it's so important to go through those numbers
Mhm.
and those details. Like it's not the conversation should never just be like, if this is your down payment. It
Yeah,
should be like, here's your down payment and here's your cash to close.
totally. Yes, I agree. All right. Well, I'm going to go through a little bit of myth versus fact in the mortgage industry. So
Yay.
I'll say a couple of things. You reply with if it's a myth or if it's factual or yes or no. And you can
Cool.
elaborate on any if you feel like you want to say more. But I know some of these we kind of covered already. Like, do you need 20% down?
No,
Perfect.
technically three,
Do you need
but you can finance it.
a perfect credit score?
No, what's perfect credit?
And I think this is interesting. We kind of talked about it, but should you pay off every debt before buying?
No, no. Always talk to your loan officer or lender first. Once that money is spent, it's gone.
Right.
And there's a lot of things we can do to be creative to make your money work a lot harder for you.
I think this is a big one. A lot of people struggle with student loan debt. So student loans mean you can't qualify.
No, not true. Depending on the loan program, we calculate that payment differently. And that's like if it's in deferment or forbearance.
How about you should always choose the lowest interest rate?
No. So, one thing that I see so often is, and obviously, like I get clients who will shop the rate, and as they should, everybody should get multiple opinions. But oftentimes, what some lenders will do, some online lenders especially, they will charge a client points for their interest rate.
Mm.
And so they might be saying, hey, Danica, here's a 6.25 interest rate, and Taylor's at 6.5.
Hmm.
But what they don't tell you is that they're charging you 1 point or 2 points. And 1 point equals 1% of your loan amount.
Mm.
So that can add up so quickly. Yes. So it's not always apples to apples.
Is that something where, I mean, obviously it has to be disclosed somewhere. Something
Yeah,
that you think a lot of buyers just don't understand or
totally. Number one, I don't think a lot of buyers understand. And I know that because we talk about it
Mhm.
and they don't generally know. And then number two, it can kind of get hidden in the disclosures. And sometimes the client isn't actually even receiving those disclosures while they're like kind of out shopping.
Mhm.
And so it can be like a verbal, well, I can do this,
Sure.
but you don't see the full numbers behind it.
Yeah. That
Such a good question.
and then what about renting is always cheaper than owning?
No, no, because I've had clients who've like bought houses that they've rented for 10, 20, 30 years and like they've paid for that house
Mhm.
2, 3 times over. Yeah, like it might feel cheaper like in the moment,
Mhm.
but you never have equity. Like you are never paying yourself. And so, yeah, very rarely do I think renting is actually cheaper.
And you're just also not very in control of increased rent by 20% or whatever that looks
Or if they decide to sell that
like.
property,
Yeah.
and then you don't have a place to go. There are so many things, and I've s- I've seen this impact families very negatively when they call me and they're like, I just got notice. I have to be out of my house. I have X amount of kids. Like, I don't know what we're gonna do. Like scrambling to get hopefully pre-approved to buy a house.
Yeah.
Mm. And like, how much nicer would that be if you were doing it on your terms
Mhm.
and not somebody else's?
Totally. Another one, it's better to wait until rates drop.
No, because when rates drop, everybody's re-entering the market.
Mhm.
So as rates drop, like your competition has just gotten so much heavier.
Yeah.
So more than likely you're paying more for that house because now you're competing.
Mm.
Whereas like you can always refinance when rates drop. It doesn't change the price you pay for the house.
Right. Totally. Is there just another myth that you find yourself correcting almost every day?
Well, a good one is surrounding first time home buyers. So there's two pertaining to that. Number one, Even if you have owned a home before,
Mhm.
if you've sold it and you have not owned for 3 years or more,
Mhm.
you are considered a first-time home buyer again.
Oh, interesting.
Yes. And then the other one, you might be a first-time home buyer and you've never bought a house before, but depending on your income, you may not qualify for many and or most of the first-time homebuyer programs
Mhm.
because the majority of them have income limits. And that's one that people don't generally know.
Yeah.
And it goes off of the area median income for the county in which you're looking to purchase in.
Mm. Yeah, so that can be a big change too.
Yes, definitely. And that's again like why we like to start the process sooner than later
Mhm.
so that we can be strategizing the different options to really maximize what you can do and making sure that we're just like putting you in a position to reach your goals.
Yeah, absolutely. If someone listening wants to buy in the next year but feels overwhelmed, what would the first step you would recommend be?
First step is to call me. No, you can, but honestly, get in contact with a loan officer or a lender that you trust and just have a conversation and start an application. You're not on the hook for anything,
Mhm.
but so often, like people will get paralysis, like paralysis analysis or
Yes.
analysis paralysis,
I know what you
and just like not knowing where to
mean.
start.
Mhm.
And that's where I come into play. Like if I can take a look and calculate your income, look at what you have for debt, and just start putting together the pieces, like I can do that work for you. You don't have to have it all figured out.
Yes, I love that. I know people get weird about things hitting their credit score. I know a pre-approval does, but it's not super detrimental.
No, credit pulls actually make up about five of a person's actual credit score. And fun fact, when you are like shopping for a pre-approval or a mortgage, you have a 45-day window. So you could get your credit pulled from 10 different lenders 10 days after each other.
Mhm.
And it will all count as the same credit pull as long as you're in that 45-day window. And the best, like the best analogy is if you were going to go shopping on Black Friday and try to open up 10 different credit cards at 10 different stores,
Mhm.
the credit bureau's going to look at that and be like, this is kind of sus.
Yeah.
And you're probably going to see your score impacted. But if it's for a mortgage purposes, it nearly has it has a very small effect on your overall credit,
Yeah, that's a
if any.
good thing for people to know.
It is. And you want a hard pull. You don't want a soft pull.
Mhm.
It just doesn't show the lender everything.
Right.
And that defeats the whole purpose.
Totally. If listeners only remembered one thing from today's episode, what would you hope that that is?
That you too can become a homeowner, but you need to have a conversation and start putting the pieces together to see what is possible. And if you need to like pivot and shift gears, like that's okay. That's all of us at some point or another.
Mhm. Totally. Where can
Anybody can become a homeowner.
Yes, I agree. Where can people find you if they want to follow your journey and things you share? Because you share some great stuff.
Thank you. I'm on Instagram. I'm on Facebook. Tay_Dalkey_ home team.
Perfect. Thanks so
Yes.
much for joining me.
Thank you.
Yeah, it was great to hear all the info you had to offer, and I really hope our listeners take something from it.
I appreciate it so much. I was happy to be here.
Thanks for hanging out with us between showings. If you love the episode, make sure to subscribe, leave a review, share it with someone who you think would find value in the conversation, and we'll see you next time between showings.